welcome. Thank you for making it all the way to the end. You know what they say about keeping the best for last. So hopefully this will be a panel filled with insights for everyone who stayed all the way till the end. And so you'll be rewarded. But my name is Jules, and I'm joined here with Alex, Andreas, and Ken. I think just to start off and to give color to all the answers that will be given, it'd be great if we can just give a little bit of our story, how we ended up in our shoes today, and take it from there.
Sorry, my mic was off. I'll go first. Alex Zaretta. I don't know. my last name's a password. I started off working with student entrepreneurs. I was a student entrepreneur around like 2012, 2013, and I realized at that point I was wondering why people didn't help me a little bit more along my journey, being at such a great school like UVA. And that led me down the road to eventually working, building programs at UVA, and I wrote this whole deep dive. Ended up writing this research paper just for fun, I guess, on like what programs actually work, and I found that none of them do. But that's another story out there. And so I developed programs that they quadrupled the number of viable startups graduating from UVA. Got a ton of them into Y Combinator, which is weird for UVA. Not so weird because Reddit came from UVA. They were in the first batch of Y Combinator. And then eventually left because the university was like, it's a lot of resources on a couple of students. Why don't you just do more classes or big buildings or big events? And I was like, those don't work. Went to business school and met Amazon Web Services. They were like, how the hell did you do that at UVA? Can you do that across the United States for us? Because it sounds like a very efficient way to find the next high potential entrepreneurs. And I was like, you guys would pay me that much to do that? So I did. And yes, it worked. And I could do it from the comfort of my own desk at home because of all the pandemic changes, right, with Zoom meetings and all of that. And I lasted 6 months before I realized, if Amazon wants me to do this, and I don't like working in Amazon, how can I do this for myself? Ended up starting my own fund called Not Yet Ventures, where I focus on meeting students in US universities before they're investable, when nobody really wants to talk to them. And I evaluate them based on their engagement on the process, right? And if they're not working on it, that's fine. We don't need to talk, right? But as soon as you're working on it, I want to be there in the weeds with you and maybe be that first investor. So I'm here because I met Justice from 161. He sent me some students from UF, and I met him in November. We met once a month for the next couple of months. I had the conviction, put in the money. They put in some money, and then we got them into Y Combinator. You guys saw them up there, Nolify. And so that's what I'm about at Not Yet Ventures.
Excellent. Hello, everyone. My name is Andreas Calabrese. I'm one of the co-founding partners and current general partner at Tampa Bay Ventures. Put in pretty basic terms, we invest in interesting startups that are based in Tampa Bay or in Florida. Our thesis started in kind of around 2020, where we saw the number of both exceptional people moving to the state, the dynamics of work from home changing significantly. We thought, hey, there's a real space for a world-class venture firm to be domiciled not just in Florida and be investing in some of the greatest companies to come out of this state, but we also thought that Tampa Bay was going to play a unique role in that. And fast forward to today, 2 of our unicorns have raised $750 million this year. So it seems like a bet that's worked out. But prior to moving to Florida, I had no context on the state. I was living in Stockholm, Sweden, was investing in hardware businesses, ended up joining one of our companies as their 4th hire and finance lead. And we had to be close to a customer. So with 3 days notice, packed up my car, drove down to Florida, and then saw I was incredibly undervalued when I got here. And that the rest of the country and the rest of the world certainly has a perception problem, but I think others have mentioned this. I mean, this is the 3rd largest state in the country, 15th largest economy in the world. To bet against venture scale outcomes here would frankly be crazy, so.
Ken Hall, there we go. Partner at DeepWork Capital. So prior to DeepWork was in New York City, worked for IBM, did M&A for Watson Business Development, and then moved in to help restart the ventures team. In addition to that, kind of through business school, and one of the ways to kind of break into venture, I tried to get as many firms as possible to let me do free work and prove that I wasn't a complete idiot. Eventually tried to start getting paid to do said work, and a couple firms hired me, let me do some diligence on some deals, so wound up doing 10, 15 transactions kind of on the side throughout business school and during my time at IBM. So then when tried to make the leap full-time into venture, had a Rolodex of family offices and venture firms that said, yes, this person is not a complete idiot. You should maybe consider hiring them. So that helped me break full-time into venture. So joined DeepWork, similar thesis to Andreas, where I was in New York City at the time, saw a lot of capital in a lot of opportunity to invest in undercapitalized markets and build globally scalable companies from anywhere in the world. And if that's the case, then why not do it in Florida? Joined DeepWork as the three founding partners and myself. We've grown from about 25 million AUM to now around 350 million AUM. We have 80 active portfolio companies, largely within the state of Florida. We invest about $30 to $40 million per year. We've invested in about 15 new companies and 10 to 15 follow-ons in any given year.
Great. My name's Jules Deplanque. I have nowhere near as good of a track record as these guys. I just graduated college like 4 months ago, undergrad. But I'm originally from Singapore. I got my start in venture when I was in the military in Singapore. I was diagnosed with a stage 4 cancer, given like a 50-50 chance to live. And when you're told that when you're 18, you get this unsurmountable hunger to live and to make a name for yourself. And so during my chemotherapy, I ended up joining a private equity fund and helped launch a climate tech VC fund across Europe and Asia. Fair to say, I fell in love with the process. And so when I went to Babson College in Boston, it was all about how do I go work for Sequoia? And so my strategy around that was, let me go work for all their portfolio companies, make a name for myself through that. That never worked. That was the slowest way of possibly getting into venture. I talked to Sequoia for 4 years and it kept being like, we don't really hire out of undergrad, etc. So you might have heard Yusuf earlier, who's on the Young Investor panel, who's my other co-GP. We met up in our senior year of college and we said, fuck it, let's just make our own Sequoia and let's fight against the big dogs. And so here we are today. We did our first close about a month ago, and now we're investing in student founders, much like Alex. There you go. Well, as an outsider, I want to kick this off. Silicon Valley is known, obviously, for the ecosystem of startups, and we've heard today again and again that's why startups move there. New York City has the financial hub. It has the networking aspect to it. Boston is really known for its biotech or its strong talent networks. What is it about Florida that would entice investors to invest here or entice a startup to move here? What is the edge of Florida and how is that developing?
Sure. I'll take that. Yeah, I mean, from a company relocating here, I think it's pretty obvious. Probably 5-6 years in a row, it's been one of the friendliest business environments in the country. So it's hard to beat that when you're ranked #1 for best state to do business. That's a pretty easy argument. From an investor's perspective, I mean, I actually think that the diversification is actually what makes the state interesting, right? Where in Florida, I mean, you mentioned Boston being a biotech hub. New York, there's a lot of kind of enterprise infrastructure and financial technologies because of the banking presence. But in Florida, I mean, there's billion-dollar late-stage biotechs, there's billion-dollar late-stage insurance companies that went public, there's billion-dollar Web3 blockchain companies. We have a lot of aerospace and defense, space tech innovation. So to me, the breadth of industry and companies that are really succeeding, starting to hit that 100 million plus kind of revenue velocity shows that you can not only exit businesses here, but that you can found them and grow them and scale them to venture-like returns.
Yeah.
Yeah, I mean, I think Ken makes most of the exceptional points. When we were looking at founding the firm in 2020 and early 21, we actually had a list of reasons why venture firms shouldn't exist. Because we were just doing some investing as like a multifamily office and building, and I'm sure Pablo and Justice and others in the room who are on like building venture firms can attest to. Building venture firms is really hard. Like nowhere near the level of difficulty that I think building a product business as a founder is, but it's still exceptionally difficult. And so one of the standout aspect or elements that we saw in the state was the University of Florida and all of the university system broadly. But like when we went to Facebook, or we went to Meta, we went to Anduril. We went to every top tier technology company that we could look for, and we filtered their engineers by graduates from University of Florida. And every single one of those companies, we saw that there was at least a couple of graduates, and in some cases a high density of graduates from University of Florida. Or in biotech, there was a high density of graduates from University of South Florida or what have you. So we saw that there was big outcomes. You have a big state, there's a big economy. All three of these cities are in states that you named are some of the hardest to do business in, right? And I think they've succeeded because their density of people. We have the density of people here. We're not mining from some fixed resource. You just need a flywheel effect of some companies to be built by great founders that went to UF, exit, invest in their friends' companies, right? And then next thing you know, you have a number of unicorns being built every single year. So I think for us, it's the density of talent in the size of economy. It's just an obvious outcome over the course of my lifetime.
That makes a lot of sense. I was going to turn this question to you, Alex, because I know you don't exclusively invest or...
I'm not from Florida.
Yeah,
so
exactly.
So that's why I wanted you guys to go first.
So Alex, I know that you, for example, your strategy is much more different in terms of where you look for founders. When we were talking yesterday night, it was more so I look for founders where people are not looking. What is your thesis around that? Why is that the case?
Well, okay. If you were going to go look for young founders, especially at a university, where would you go first? Besides there, second. So then Stanford probably, maybe Cambridge. Maybe like the Boston area. But like, their founders come from everywhere. There's a saying that is that talent is equally distributed, but opportunity is not. And so someone on an earlier panel actually said that, yeah, at some point you may have to go out to SF or New York City to grow your company. I mean, hopefully not, right? But and it won't be the case for long once we get these ecosystems up. But it can start anywhere, and these companies are starting anywhere. I come from a place called Charlottesville, Virginia, which is known for many things. But as I've come to see Gainesville, this is my first time here. There's so many similarities, right? It's a huge flagship university of the state is around here. A lot of people work for the university. We also have a wedding industry there. It's not just the the thing that's there, but Charlottesville has a bunch of people moving back because they love it. It's a great place to raise kids, as the hotel clerk told me when I checked in. It's just a great place, and more people wish that they could stay here, right? So let's, we can make it happen. So when we look there, right, if you're looking in places no one is, you have the chance to really let those people who are willing to work, right, who are, someone put on this earth by God to do whatever that is. I think that Yusuf said that, right?
Yusuf, yeah.
Those people exist everywhere, right? And they're not just in one place. And so if you can find them before they get jaded and have to move out to Silicon Valley or to Boston, right? Like, let's keep them here. So I think that's where I'm going to find alpha, honestly.
Yeah. No, very clear. And as we are all early stage investors, what is your typical founder archetype? What is that one founder type where after a 10, 20, 30-minute call, you're like, wow, this is exactly what I'm looking for?
I mean, I'll let you know when I find it, because that'll be a career-defining investment. But diving into this first, I would say there's very different. I think the thing I've learned across my career, this is my now 11th year in venture or building venture-backed companies, is that you learn different types of archetypes, right? When I was first starting in venture, I had this like very specific mold of, I was in Sweden, so like Daniel Ek was essentially my mold of what a successful founder and CEO would look like. He is very different from CEOs in Silicon Valley, right? Like, he's famous for playing PlayStation in the middle of the day in the office, but then being incredibly like zoned into the thing that he's working on in that moment of time. But I would say generally you have to be one of the most exceptional people I've ever met in my life in the area of where you're responsible for being like the T of your organization, right? If you're an engineer and like your superpower is engineering and you're bringing that to the company, you really should come off as one of the most exceptional engineers I've ever met. If go-to-market function is your talent, then you should be coming off as one of the most exceptional go-to-market people I've ever met in my life. But then broadly, some of the most intriguing and most successful founders I've ever come across have had the worst pitches you could ever imagine, right? Because they were so deep in the problem, they were so deep in what the future for them looked like, that preparing the narrative of what they're working on was almost not that important. And it sounds super counterintuitive, but I think that the founder that is so obsessed with the problem and the user and the space in which they're working in, that everything else almost falls to the wayside, including some, in some cases, even like their personal lives. That's generally the mark of somebody who you would start to think of like, hey, this is someone who can build $1 billion company. This is somebody who can build a $10 billion company, and I'm willing to go along for the ride and deal with all the headaches and support them on that journey.
Yeah, I would echo a lot of that. I mean, I do think that especially locally, I find that a lot of founders in Florida don't sell themselves enough. And I think you said it right, with a superpower, you have to have something that I can hang my hat on, that I can build consensus within my partnership as to why we should bet on this person. And it might be you're a 3-time exited entrepreneur, but it might just be, you know, exceptional engineer, and I can build a thesis around that internally. But there has to be something that you can pitch yourself on that distinguishes you, that can help me build consensus internally, that we want to back you as a founder in this space. And then the other thing is just, especially from an early stage investments, like we also make later stage investments as well, but from a seed stage, it's like I have to be able to get comfortable that the founder's not going to go to bed at night or rest easy until if door A is closed, they're going to try to go through door B. If door B is closed, they're going to try to go through door C. If door C is closed, they're going to make a door. And it's like tenacity and just relentlessness at the earliest stages, from that obsession of the problem and trying to build the company that I can hang my hat on and bet on them and rest easy from a seed stage.
I actually want to build on that. So your original question, just going, because we're actually getting away from it, you said in the first like 10, 30 minutes we meet them, what's the archetype of how we know?
Yeah.
How can you tell if they're relentless, right? It actually takes building a relationship with them. And so that's what I'm trying to do in the early stage that I haven't seen from most investors who want to be early stage. You go to an angel group, they're looking at your deck, right? They're screening you, and then they get up into a pitch, right? They're never going to see that thing. Even places like Y Combinator, right? Like it's an application, and then it's a 10-minute interview. It works now, especially because like they could throw a dart at the application pool and probably get some good founders. And then they have a great program and network that's out there. But I think for us, right, we see this ambition, this ability to get around obstacles, right? This relentless drive, this person who's curious, this person who's like a good person. They've got integrity. I think Michael Gibson, when he was up here earlier, said something about how character, right, is in kind of like short supply. So finding those people who have those traits that cannot be faked with behavior, that's when you have something. And then the question is like, is this the time to invest with them? And is this the right idea?
Totally agree. I think a lot of what we see today is people being delusional for the sake of being delusional because that's what sells. But digging deep into finding if they are actually delusional takes building a relationship, which building a relationship when there's a founder VC hierarchy becomes a little bit difficult. How do you break down the hierarchy and make the conversation and the relationship feel natural, which I think personally is how you get deep down into who the founder really is.
How do we break down the hierarchy?
How do you make a founder feel like they're on the same level playing field as you?
If you do that.
If you're able to do it.
No, I mean, I just feel like that's over the course of multiple conversations and building trust, and I mean, I feel like that just comes out naturally over time. I don't know if that's necessarily something that you have to work through. I feel like that's a dynamic that evolves naturally through trust and alignment of interests. And if at the end of the day, like, I do want to be on the same side as the entrepreneur, but also I'm representing my LPs, they have to understand that dynamic. But we're all aligned on the incentive structure, which is creating a bigger outcome for the company. So I just feel like that evolves naturally over the course of a relationship and over the course of diligence and over the course of conversations. And if it doesn't, then we usually don't get to closing a deal together.
No, yeah, that's fair. It has to be natural for us. When we're meeting with students, sometimes it's like their first time pitching, and so there's this like nervousness of pitching to us, and it's like, dude, we're basically the same age, relax, let's keep it casual. So that's why I asked that question.
I got an answer for that question.
Go for it.
So a lot of what I do, I love what you say, we're basically trying to get on the same page. And so I'm up front with them, right? Very transparent about like what's going on. And I'm telling them like, hey, like I'm trying to get excited about you, and I'm able to dig deep in what's going on. But like, I got to evangelize you guys to my LPs, and then my next job once we invest is to be the advocate to evangelize the next round of investors for you. And so if I can't even do that right now, like it's not possible. My fund is called Not Yet Ventures because I truly mean it's not yet. I get to because I'm at the earliest stage, right? It's like, come back when we've got something. Let's get on the same page and work together even from this moment. Let me know how I can help you. There doesn't need to be this hierarchical relationship. It's really a trust bond. And if you're in a conversation with an investor who tries to pull like a power play move, like I guess you're trying to get them on your cap table, right? Maybe for like good looks, but like you probably don't want an investor like that because long term, when push comes to shove and gets really hard, like they're not going to be there for you.
No, yeah, totally agree. And we've talked a lot about the things we look for in founders. What are the biggest red flags that when you see this being repeated? it's just a
Lack
big
of
no.
integrity, number one.
Yeah.
Any little indication of lack of integrity, I mean, this is a multi-year relationship where you're, by proxy of us as investors, going to be managing a portion of our limited partners' money for us. Like, I think a lot of the venture process is essentially, like some of these guys have mentioned, is accelerating the character development arc for us to understand if someone has a lack of integrity. Like, whether or not somebody has the unique skill sets and timing and path in life to be able to create a generational company is one thing, but I don't know about you guys, but most of the companies that I've seen fail have nothing to do with the model. It's all based upon the individual, an individual choice. So for me, lack of integrity is number one.
Yeah.
Yeah, transparency, responsiveness, those kind of things can break down the relationship. I mean, like, I understand some of the pitches aren't polished because they've been heads down on the problem, but at the same time, like, the responsiveness and like being polished and presenting and talking well matters to me as an investor because it matters to potential employees or partners or customers. There's a lot of people where that's going to matter. And so I do think that just like having a polished presentation, having founders that respond quickly and promptly and professionally, like even that goes a long way because that's what customers want to see too, right? So I just think that can break down the relationship over time. But from the transparency and kind of responsiveness point, it's like a lot of founders tend to, if a problem surfaces, then they go off the grid and they're building a thorough response and a PowerPoint to come tell you what the problem is. It's like, just call me. Just tell me just send me a text. Let's jump on a call. Let's try to figure out the problem. Let's try to figure out how to move forward. So it's just that kind of proactiveness and transparency of what the problems are that I think helps not just establish but build trust over the time.
That's totally right. I want to double click on that part about being able to not necessarily the pitch, but like the like how they're communicating in the Q&A part. That's what I get. That's what's so exciting to me, right? Someone who really knows their stuff, right, or has a good vision, but maybe didn't prepare the narrative, right? You start asking them questions. They know their shit. They're bringing out anecdotes, stories, like people's names. Like they clearly know what's going on here beyond that. But talking about red flags. Communication, right? Responsiveness. I think Paul Graham has an article where he says that he looked at the data of like post-YC companies, and there was a correlation, not necessarily causation, right, for the nerds in the room, but a correlation between the startups that didn't communicate with their investors and the ones that crawled in a hole and died, right? There's a huge correlation there. And so up front, one of my things that I look for, and I tell them in the first meeting, it's like, hey, keep me up to date. Here's an article I wrote on how to produce a stakeholder update. It's a 30-second read, super easy. You're going to give me the highlights, but you're most importantly going to give me the lowlights. So I get to see like how you communicate with me when things are hard, which, by the way, if 90% of the stuff that you're doing isn't working, that's good, right? If it's anything more successful in that, then you're probably not doing the things you need to do as an entrepreneur. The last thing that would be a red flag is, we talk about coachableness, right? That doesn't mean that I have the answers. It means that like when I push you on something and maybe ask a question on this, you don't get defensive, right? You're more of like, hey, well, so we thought about that. We tried this, right? Like we're on the same team rather than them just like stick in the mud, trying to be the Steve Jobs reality distortion field type of entrepreneur. Like you're very unlikely to be successful, with a blind shot in the dark like that.
Yeah, and sometimes it's the founder selling to us, like we're looking for green flags, red flags, etc. But there are some deals that are so highly sought after, where the dynamic shifts and changes to where suddenly you're in the position where you really have to sell yourself and to to claim that your capital is the most strategic for this person, how do you sell your VC firm? What makes you convince the founder to take the money from you?
I mean, it's case. I was actually going to say that on this last point. It's not a red flag. It's not a green flag. Maybe it's a yellow flag. Is if the founder isn't actually asking anything of us or about us or from us during
I
diligence.
just want you as a check.
Like, yeah, it's like I want to know that you have I want to know that I'm your desired partner, not your partner of last resort, right? I want to know that you also want to work with me and that you're diligencing me as part of the process too, right? So I think that's important from a founder's perspective, is also diligencing us. That's a green flag to me, is them asking stuff from us during diligence or asking us questions, trying to get to know us better, and that they want to partner with us. As far as like what we can do and what we can signal, it's opportunity by opportunity. I'd say the common things throughout are like experience in the space, introductions to customers, introductions to investors. Like, just as an example, I mean, there's a deal that we closed on last week. It was a super competitive, way oversubscribed Series A, led by a $9 billion West Coast investor. And that Series A, and it's like Andreessen's in it. It's a bunch of like, kind of frothy tier 1 VCs. The only reason we got an allocation was we made the introduction to the Series A lead. So it's like, you reply on the thread and say, hey, remember me? Can I come into this deal that we helped create? So that's an example of like trying to provide value before anything actually happens with the round. So if you can provide introductions to investors, customers, things like that, that will secure an allocation, or help win the right to do the term sheet.
Yeah, and on that part of it being a partnership, Chris was telling me yesterday night that the average VC startup partnership lasts longer than the average US marriage, which...
I think Chris stole that from me.
Oh, okay. Well, either way.
5.2 years as recently married men, and early stage investors. That's very scary.
Yeah, it's inherently sad, but it puts into perspective how important it is to choose the right founder and to therefore choose the right VC. And so, finally, what is, for any founder, whether we like it or not, building hype around the deal is highly important. It gets traction running in terms of investments. How can a founder build hype themselves around a specific deal? And you can think that it's not important. That's completely fair.
Yeah. I mean, I would push back against the notion of your question, not because I don't think that you're incentivized to do so as a founder. Like, certainly that's an outcome that can help you, but that doesn't help push you closer to building a company that is self-sustaining, right? And I mean, in more of the cases than not, certainly there have been companies that have had a lot of hype or a lot of investor attention at their early stages of financing and then have become big, successful, important companies. But when I look back and like think about like the most successful companies that I've seen at the early stage, not the ones I've invested in, just the ones I've seen and have known have existed, none of them were very obvious initially. Most of them were fairly non-obvious, and that's going to be the case for most asymmetric, like big outcome companies. So I would say if you're a founder in the room, rather than focus on how do you create hype around your current financing round, let's reverse engineer the problem. Why does nobody care about your current financing round, right? The question is, are you building something that is attractive enough to society to where even investors are like, if you're right in what you're building is even remotely close to feasible, that is a large piece of a market, and we believe that you're the team or the founder to be able to pull that off, right? So I would like think of reverse of the question. It's like not how do I make my round more exciting and like generate more investor interest, but how do I make my company more societally important, more exciting to where that's a byproduct.
That's great. I love that. I approach it in two ways, right? When founders ask me how can I fundraise better, I'm like, get your numbers up. You shouldn't be up there giving marketing speak, that like big vision stuff, which is gonna be kind of important. But like, if your first thing you come out of the gate with is like, we're growing at a very large percentage month over month, a key KPI, which hopefully is revenue. Oh my God, people will suddenly start to care what is going on. So like, get those numbers up. And if it can't be revenue, like figure out what that KPI is for your company and like get it up. If it's not where it needs to be and you got to fudge the numbers, well, maybe you're not ready. Let's de-risk it. Like how can we move forward with less resources than you think that you need? The job of an entrepreneur, I think at the end of the day, the attribute of an entrepreneur, I think, is being resourceful. So, I mean, that's what I would say.
Yeah, the only thing I'd add, I completely agree. Reverse engineering this question is probably the better way. But having some people are throwing out the advice of like always be raising. I think that's just terrible advice. Like, I do think that people don't want a stale offering that I've seen and my partners have seen for the last 9 months. And okay, it came back again. And we do want something that has urgency and exclusivity and is the right time to be investing, not something that Andrea saw, and you saw every other VC has seen, right? And it's like, okay, well, we saw this 9 months ago. They're kind of same spot, same ask. Okay. It's like, I think time bounding the ask and being intentional and thoughtful with your fundraising efforts is better than having a constantly open round where you're always fundraising. I think it's important to always be networking with the intention to raise when the time's right, but don't always have a round open.
On that note, founders in the room, so once you take an investor's money, especially a venture capitalist who's trying to get as high a return as soon as possible, you are on an ever accelerating treadmill. And so if you can't keep up with the numbers that's up there, it's going to be much harder for you to compete with all the deal flow that's going in, right? It's going to be a stale deal. And so, think critically before you take even the first check.
And to finally close this off, to any student that wants to be into venture, what is the best path? Because as we all know, there is no traditional path. And so advice to the younger people in here, how can they get into this space?
I have a strong opinion on this question,
Oh, yes.
if you allow me. I mean, I'm now in venture and broke my way into venture, so I guess it's kind of crappy for me to say. But I would actually advocate most people go work for a company that produces products and like actually serve something to the world. Investors serve like a really important role, and we're really important intermediaries, and we're helping like fund earlier stage companies and empowering the individual to a lot greater degree. But by far, the most important thing that could prepare you for your career as an investor is to actually have insight into what running an early stage company day to day looks like. So if you're really serious about being a venture capitalist across your career, like going and building an early stage company for a couple of years is a relatively small amount of time compared to the amount of time you're going to be spending investing. Like, there's a lot of skill sets you'll gain, but I don't think any of them replicate helping build or being part of a team that's building an early stage company. So go build companies, don't go into venture.
Yeah, I agree. The only advice I could give is how I did it, which was do free work for a bunch of people and try to build relationships, and then if you love what you're doing, try to go full time into it. But I agree with Andreas, especially, there have been an abundance of venture firms kind of created since 2020. And I don't know if we need more investors. I think we need more entrepreneurs. And especially in the state of Florida, I think the median firm has been around for 4 years. We need like firms to get bigger. We need talent to be concentrated a little bit more rather than continuing to fracture to smaller and smaller and smaller and smaller. I think it's a challenging environment for entrepreneurs, because then you have to go to raise $5 to $10 million. You have to go talk to 5 to 10 million to 5 to 10 different VCs. When in Silicon Valley or Boston or New York or Texas, your competitor is able to do that in a week. So I think there is actually virtue of concentrating capital and allowing our companies to be more intentional and streamlined in their fundraising and in their execution and in their scaling.
I don't know if I agree on that last point, but hey, there's many views there. I do want to echo what Andreas was saying, that you really should be able to be in the founder's shoes. If you want to be in an investing role, especially with founder facing, and you can't empathize with what the hell is going on there, there's so many people that are like that, right? We don't need more of those people in there. So really get your boots on the ground. But I do have 2 actionable pieces of advice actually for if you want to get into venture. If you want to start a fund like I did, you should be angel investing right now. And what we're so lucky right now because it's actually possible to be able to put little bits of money, $100, $1,000 into these companies very early. Get a portfolio together because it's actually not about the magnitude of how much you invested and returned. It's about the multiple on that invested capital, right? That you actually were able to bring back. Most of the best new fund managers who got started were actually really good angel investors, or they were able to get allocations in deals, right? That proves to LPs a little bit, right, that like you're able to, to use their money wisely because you put your own skin in the game early. The second thing that I'll say is that there's a free program that's online through, it's called the Venture Institute that VC Lab puts together, and they're a fund admin for a bunch of small little firms, and so it's a free program, right, where if you go through the motions, like you'll get paired up with a emerging manager, and you'll actually be able to get on the ground with them and help them with some of those tasks that are there. It's by far the best program that I've seen where you don't have to pay an obscene amount of money to at least get some of the training. Now, whether or not you get a job is a different story, because for that you need to be well networked.
Yeah, and I would also echo and disagree a little bit. Much like we started our own fund, we feel like we're scrappy. Shit was super hard to go fundraising, to start a company. But if you find unique access and opportunity, just like 161 did through their events, then you're the only person with that access and that opportunity, then I think it makes sense to start a venture fund. And when you're starting a tiny little venture fund, you're very relatable to founders because you're pretty much just as broke as them. There's a paradoxical environment where you're writing like a $100K check and you're barely even taking a salary. So I would agree and disagree. But yeah, thank you very much.
Thank you.
Thank you.
Thank you all.